for that. Alright, but let me know if you guys understand what is happening. So I'm going to repeat it. So to the right, this person, right, they were just using, a particular lot size. So, they said, whatever trade comes in, they're using a 0.05 lot size. Whereas the person on the left was risking a percentage of their account. So what that means is that their lot size would vary based on the size of the stop loss, right? Based on the size of the stop loss. And so, because they're taking the same risk every time, so the stop loss could be 50 pips, the stop loss could be 20 pips. What is consistent is that they're risking about 3% of their account. Okay, what's consistent is that they're risking 3% of their account. Whether that trade had a 100 pip stop loss, a 50 pip stop loss, or a 20 pip stop loss, they're only risking 3% of their account. So if they lose, their losses are consistent. Look at the left. You see the losses are the same, right? They lost $3.87, lost $4, lost $4.01. The losses are the same. If you look at the right, the losses are $20, right? The losses are high, right? Much higher, right? If we had to take some losses, on these euro odd trades, right? You would have seen, like for example, the losses would have been would vary significantly, right? We wouldn't see, consistent losses. So if this person on the left took losses on euro odd, they would have also lost $3.87, $4 or $4, on their trade. Where person on the right, those losses would have fluctuated based on the lot size, right? So the lesson here is, and this is why I always say, when you are trading, you use a percentage, right? Your losses should be predictable because you might be thinking that you being all, good with your risk management, saying, oh, listen, every trade that comes in, I am using a point 0.1. I'm using a point zero 0.05, like person on the right, right? I'm using a point zero 0.05. So my risk is consistent because I got $500 in my account. I'm using a 0.05 risk. Absolutely not, right? That is the very beginner. I don't even recommend it to a beginner. I tell individuals, like that's like a very fast way to put in a lot size. But ultimately, guys, be able to calculate your risk, right? You see the difference here. That's the difference between you and you being profitable, right? And you actually losing. Because we took, for example, here, this person they took the exact same trades. You can believe that me and you in the market, I take the same trades as you come out in a loss and I come out in a profit. I'd be mad. I'd be like, bro, what's going on here? What's the robbery that happened here? The robbery is you're robbing yourself, right? And this is why, like I said, you always want to make sure you are using risk percentage. It's an investment, so invest in percent, right? The lot size will vary. Now let's make this very, very practical, right? Let's make this very, very practical here, guys. Let's hold up. All right, we're gonna make this very practical and give you some examples of this. All right. All right. So let's talk. Like I say, we're gonna talk some risks today, right? Because after this, now you're gonna see, all right, yeah, you see that 0.1 or point zero 0.05 lot size, etc. For every trade, that is madness. All right, that's a waste of time. You end up, losing, whereas you could actually be profiting, right? So, for example, let's use the example here, right? We have, we're gonna put this as our, just gonna call this SL, right? You guys can see the screen though. Do we need to zoom in or be good? All right, let me know if you're good. We good? Okay, awesome. All right. All right, so this is, we can call this column lot size. This column is stop loss. This column is value of lot. All right. We can call this value of lot, and then um money. Yeah, this is how much we either lose or gain. Okay. So for example, here we got a 50 pip stop. We got a 20, whoops. We got a 50 pip stop loss, right? We got a 20 pip stop loss here. We got a 30 pip stop loss here. We got a 10, right? We got a 15, right? Then we got here a 100 pip stop loss, yeah, etc. Right? So, all right, so what we're gonna do here now, very random, right? So this individual, give me a lot size, guys, right? They got $1,000 in their account. What lot size they're trading at, right? Just like if it were you, right? Your thought process, if you were just using lots. Okay, cool. This person is using a zero point 0.1 lot size. Okay. We know that zero point 0.1 is valued at $1 per pip, correct? All right, this is $1 per pip. Okay, good. So this is what we're gonna do. So that person uses the zero point 0.1 lot, and it's valued $1 per pip, right? So now we're gonna work out what their actual losses are, right? Which is, exactly what's here anyway. So we're gonna work it out. Right? So this person lost $50. All right. They lost 50, they lost 20, 30, 10, 15, and $100, right? Based on their loss, right? So the total amount of money this individual lost, yeah, is $225, right? Now, we're going to take this very same scenario, guys. Yeah, like I said, I want to make it practical. I want you guys to see it. We're going to take this very same scenario and we're going to put this right here. Now, this individual has the same $1,000, okay? The same $1,000, but they are risking 3% of their account, okay? They're risking 3% of their account, okay? So that times 10, boom. All right, cool. They're risking 3% of their account. Now, first thing you want to identify, all right, if you're risking 3% of your account, you want to identify what is 3% of your account. All right, what is 3% of your account? We know that 3% of $1,000 is how much, guys? It's $30. All right, it's $30. Okay, cool. Right, it's $30. So, I think I got the formula for this somewhere. We can make this faster as well. Mm, Let me see. Do I? All right, one sec. I want to make this. Oops. What did we do? All right. Yeah, I want to make this much quicker. Give me 1 second. 1 second. I actually posted one in the chat the other day. All right, posted one in the chat for you guys. I hope y'all utilized it. Take a look at it. All right. Let's see. Putting it up here on my screen now. Oh, it's open already. Okay, cool. Let's go back. All right, yes, this is perfect here. Okay, cool. So I want you to remember, we're gonna put these side by side. I am going to put it back here so you guys can see. I don't know if I can put it side by side though. All right, can you guys see this? Can you? Can you see my screen now? Yes, okay, good. All right, I'm gonna zoom in. All right, I posted this in the chat. I don't think I could zoom in on this. So can I? I can. Yeah. Yeah, I made a fancy one, you know. There. This good? That y'all can see this still is good? Yeah. Okay, awesome. Perfect. All right, so I want to use the same numbers that I just put in on uh okay, good. All right, perfect. All right, cool. So we got the spring split. All right, so we're gonna use the same numbers, everything here, the same stop losses, etc. Okay. So this right here, hopefully it does what I wanted to do. So it was a 50 pip stop. Okay, good. Yeah, the numbers changed. Perfect. 50 pip stop loss. The next one was 30. The next one was 10. The next one was 15. All right. And then the next one was 100 pip stop loss. All right. Now, this is based on how much money? Oh, good, $1,000. All right. Same thing. So first and foremost, I want you guys to look at this and see, look at how the lot sizes change, all right? 0.06, 0.15, all right? 0.11, 0.35, 0.27, and a 0.04 stop loss, all right? Look at the difference with this over here, and look at the difference here. Look at all the stop losses. Of course, all the lot sizes, sorry, are 0.01 lot. Whereas over here, your lot size will fluctuate, right, based on the size of the stop loss. So the bigger the stop loss, the lower the lot. All right, so stop loss is 100 pips, lot size is 0.04, right? Stop loss is 50 pips, lot size is 0.06, right? So your lot size is going to vary, but what is what is basically going to be consistent is the losses, right? I mean, it's going to differ here a little bit because they got some calculations happening here, all right? But your losses are going to be within the same region, okay? So seeing that we already got the numbers here, let me just type it back over this side so that we could just roll with it, all right? So just about 0.06. Yeah. Hopefully it, like I said, it either comes close or we would just do the math on it, real fast. All right. We would just do the math real quick. Don't worry. All right. 0.04. All right. So we're gonna shut this down. We're gonna keep one screen. All right. We're gonna keep one screen. And the last thing we basically wanted was this right here. Was how much money we were actually going to lose. Okay. So this is the lot, the value of the lot times the actual stop loss, which is 30 pips, right? And then the others, it would give us exactly what the pip count is. All right, so we're gonna alter this accordingly. So this would be a 0.10 lot, and then this would be a 0.30 lot, and this one would be probably a 0.20 lot. Yep. And then this would be a 0.03 lot. All right. Cool. So you see what's happening here, right? Let me know if you're following. So as we look at this, you see lot size is changed 0.06, 0.15, 0.1, 0.3, 0.2, and a 0.03 lot. All right. The value, right? The lot size, the stop losses differ. So of course my lot sizes need to differ, but guess what? It's in common, my losses are the same, right? So here, this individual, right, would have lost only $180, whereas this person lost 225. We took the same trades, right? The same trades we took. But look what's happening here. 180 versus 225 because you want to be lazy and just put in a zero point 0.1 lot per trade that comes out. Right? But it showed you guys what can happen on the flip side Whereas with your gains as well, because watch this now, right? Watch this. Let me show you something here real quick. All right, we're gonna input the same take profits as well. All right, we're gonna input the same take profits as well, and I'll show you how this could differ. All right, so take profit. All right, take profit. You had a 50 pip stop loss. So somebody give me a take profit. Stop loss was 50 pips. All right, so what was the TP? Let's see how this works out. What was the take profit? Jeez. All right, 120. What's the take profit? All right. Here, 20 pip stop loss. What was the take profit? All right, here's what we're gonna do. We're gonna just do one to threes. All right, yeah. All right, so this was 60 pips. This one was 90 pips. This one was 30 pips. All right. This one was 45 pips. And then this one was a 300 pip take profit. All right. So this was the loss for the stop loss. So we put SL. And this was the gain for the take profit. Okay, this is the game for the take profit. So let's see what we would have actually earned, right? Yeah, we don't gotta do the math for that. We can see, right? So you would have earned 120 on this trade, right? Here you would have earned 60. Then you would have gone on to earn 90, 30, all right, 45, and 300. All right. So this would be a 645 gain over here. Okay. We're gonna put in the same numbers once again, guys. I hope it clicks because I'm showing you like this because I want it to click, all right? And then people actually get the sense of like what's going on when they actually see it happen like for real. All right. And they see it actually happen for real. So it's like, all right, okay, I feel you. See what's happening now. All right, see what's happening. So you might get some differentiations, obviously, because lots and so forth. Some trades win, some trades lose. We're gonna just go with all trades just winning. All right. So let's go. So this is the take profit here. All right, this is your TP dollar amount. Okay, this is your TP dollar amount. So what does that look like? That would be this, your lot, times the take profit. All right, the value of the lot times the take profit. What it? Am I right? Am I right? All right. Yeah, 60 cents. All right, cool. And here, very, very, very. Am I right? Yeah. Okay, cool. Value of the lot times the TP. All right. All right, cool. Yeah, I think we should be straight on the rest. So all I know was this. All right, cool. So again, what happens is that no, you see that your earnings are more consistent, right? You don't earn as much as over on the other end, right? So you earn 522 here, right? With a potential loss of 180, you earn 645 here, the potential loss of 225. No, the thing about this, all right, and this is what I want to show you guys. The thing about this is that obviously this is no, in all things being equal, that you win all of your trades, all right? In a scenario where you win all of your trades, of course, if you have the same lot size, you could, of course, come out bigger or better, right? But when you've got scenarios where no, you could lose, right? You could lose more, and then that's when you put yourself in a funny situation, right? Or not where you can lose more, but rather where there's loss included, right? Where there's loss included. So in this scenario here, like you got all of your trades, you know that you can lose only $30. Whereas in this scenario, if you lost one trade, for example, here, right, at this 100 this $100 loss, right? That would have already, set you back significantly, right? You already cut your losses, by $100 from one trade, right? So let's just say you took two losses, right? You took two losses on this scenario one. You took the first trade, you lost. Second trade, you lost. First trade, you lost 50 pips. Boom. Right? Second trade, you lost 100 pips. Bam. All right. So you lost one, that's 100, that's one, that's 50. You lost $150 from those two trades, but you were 4 out of 6. Yeah. 4 out of 6. One, two, three, four, five, six. Right. You were 4 out of 6 and you lost $150 from two trades. But on this end, you lost those same two trades, right? Here, right? You lost this trade, for example. Yeah. And see, you lost this trade, boom, that's $30. And then again, at this point, you lost another $30. Boom. So you lost $60 on this setup. All right. You lost $60 on this setup. Whereas over here, you lost $150, guys, right? From those same two trades. Right. It is going to be much better for you. This is the point we're driving home. It's going to be much better for you to use, right? To use the yeah, don't let's complicate it. You know what I mean? Keep it simple, right? It's going to be because it could, of course, the numbers could grow, etc. And so on. Yeah, but we keep it simple. I just want you guys to grab this point and run with this. That's all you need, all right? It's going to be much better for you to utilize, right, your percentage where your lot size could change because I mean, think about it like this, all right? Think about it like this. This trade, for example, had a 10 pip stop loss, right? A 10 pip stop loss. Over here, we had the same 10 pip stop loss, right? But you use a point 0.1 lot, which means at max, you would only lose $10, which means you have significantly under leveraged your account, right? So you only risk 1% on this particular trade. Yeah. Whereas here, you're still within that 3% range. But your loss remains the same, but the potential for gain is significantly higher, right? Look, so you got a point 0.3 lot, take profit is 30 pips. The potential for gain is $90. Over here, the potential for gain is only $30. You guys follow me? All right. Did that at least make sense? Right? I want that to stick and drive home in your mind. I was like, okay, I see what's going on. The smaller the lot, the smaller the stop loss, the bigger the lot size, the bigger my profits can be. That makes sense? The smaller the stop loss, the bigger the lot size, so the bigger my profits can be. Whereas here, it don't matter. It don't matter because every trade I'm taking, I'm using a point 0.1 lot, right? So my take profit might be, yeah, 30 pips. My stop loss only 10. I still only walking away with $30, right? Or take profit for 45, I still only walking away with $45. Whereas in these two trades, I walk away with 90, right? I walk away with 90 each time. Yeah. So smaller the stop loss, the bigger the lot size, and the bigger your profits can be. That's the point I already want to drive home, and I hope it makes sense. I hope you guys caught it, right? I hope that's it. All right, cool. You see this? That's the way I need to go, right? Because now it's not about point one, point one, point one, point one, point. No, absolutely not. You let it vary based on the trade itself, right? How great I feel when I put in a trade that the stop loss is like 10 pips. Now it's like, yeah, boy, I could throw up my lot size, right? Because my risk is basically, from a stop loss standpoint, is much smaller, right? Same percentage I'm risking on my account, so I stand to lose the same amount of money, but my rewards is now much bigger. All right, my returns now are much bigger. Right? That's the perspective that you want to look at this thing through, right? It's going to help you significantly. You're going to see that you're going to turn losing weeks into winning weeks, right? Like it's just gonna help you significantly, man. All right. So if that made sense. Let me know in the chat that made sense. All right, let me know in the chat if that made sense. Needed this reminder. Yeah, absolutely. All right. Let me know in the chat if it made sense. Talk to me, guys. We got 35 of us here, right? I need some responses from y'all. I need to know that y'all caught it. All right. Okay, good stuff. Perfect, perfect. All right, needed this. Yeah. Yeah, good. Right. I felt like y'all needed it. I just had that feeling today. I was like, yeah, I feel like y'all gonna need this. All right. All right, cool, cool, cool. So always remember that, this standard lot size across the board, it ain't that useful. Don't be lazy. Do the math. All right. Even if you just gotta do the math beforehand, like even if it's not like specific, all right. What I mean is that obviously your balance changes over time. So sometimes you can get like an estimate. It's like, okay, cool. At max, I may lose, $28 or something. All right, cool. That's fine. Whereas you know that your 3% is $30. That's fine, right? It may not be like super accurate all the time, but at least be as close as possible rather than be far off with a standard lot size, right? All right, so next, if that was number one, number two, I know a lot of people ask this question. I know a lot of people probably getting this question going and coming in the beginner side. All right, but a lot of people messaged me today about this EA trade, right? Anybody got stopped out? Like, I want to see your hands. Anybody get stopped out? Like, the chart was so far away from the stop loss, but anybody get stopped out? Like, when you look at Charles, like, bro, that is nowhere near my stop loss. How did they get taken out? Right? Let me know. Anybody got stop out? All right, we're gonna talk about it here real quick. All right, let me know, let me know, let me know. Don't stick up. Talk fast, fast. Not the trade, though. All right, what's the trade? I didn't see that many people took the trade. All right, cool. So for those of you that got stopped out of the trade like I did, right? Like I did, let me tell you why you got stopped out of the trade. All right. So around 6 p.m. every day, what is known as spreads in the market. When you open your MetaTrader, right, MT5, etc., you see there's two lines when you go to place a trade. Anybody ever seen that before? All right, there's the red line and the blue line, the ask price and the bid price, right? You see two lines. And between those two lines is what you call the spread, right? That's what's called the spread. Like that's where the broker collects commission and so forth, on that. So when you go to enter a trade, you don't necessarily get in like, where you thought you would have got in because of the spread. Okay. Now, with that, all right, at at 6 p.m., all right, Atlantic Standard Time every day, all forex pairs, all right? So you don't see this on goals. If you're trading gold, you don't experience this. That's kind of where I like gold to, all right? So on all forex pairs, what happens is that the spread goes from being like something like this. Like right now, I think it should be back to normal, right? Perfect. So go to your MetaTrader right now. You'll see the spread is small, right? The spread is small. You'll see like the spread on EA it's like 1.657 and 1.6578, and the other one's 1.6580. Right? The spread is small. Right? If you see it, just type, yeah, I see it. Right? So it's that the spread is small, right? Now, what happens is that 6 p.m. you see the spreads do like this. Right? The spreads get extremely big, right? So you'll see, like for example, like here, we're posted this screenshot and stuff in the chat. This is where the market was actually at, right? So like the market was here, but based on the actual trade, it was showing us that like we were like here, yeah. Based on the spread, this is where it was actually showing us. So what happened is that, right? What happened is that when price was higher, right? When the price was not down here and price was actually like back up here, You see how it could surpass our stop loss, right? You
Right,
see how it could
supposed to be
surpass our
sharing your
stop.
screen?
Yeah. Oh, y'all. All this time y'all not seeing my screen?
Uh-uh.
Y'all tripping. Y'all tripping. Y'all not saying nothing. So, y'all can see my screen now? Let me see. Yeah, okay, cool. Right. So what I was saying is that basically this is where like this is how the spreads work, right? So it's like the price was actually like here, right?
Can't hear you, Clay.
Huh?
Clay, no volume.
Yo, guys, I, I don't know what happened there, man. My phone got kicked off. I got kicked off the call. Y'all can hear me now, right?
Yeah, we can hear you
Oh my
now.
goodness. You're trying to play with me today. This is so start over. T. Not start over. All right, let's try this again. All right. So basically what I was saying, guys, is that based on spread of the market, okay? Based on the spread of the market, spreads got bigger at 6 p.m. because they got bigger at 6 p.m. when the market was down at this point here. All right. So this wick and price came down to this point here. All right. It was as though price was actually up here based on the spread, right? Because the spread went from being like this size and it opened up to this size. Okay. So when the market was actually up here with this wick, it was like if price was actually here, right? Like just based on the size of the spread, it was like if price was actually here and basically like took us out the market, although the market never actually got there. That makes sense. All right. So you'll see your spreads are going to be big on pairs like EA, EN, GA, GN, G Chef. All right. What else? Um, Yeah, mainly those peers. What's gonna happen for gold is gold is just really and truly gonna close at that point. So there's gonna be no movement for gold at that time. All right. Market basically does not move, at 6 p.m. Right. Closes for the hour and then starts back. Some actually give us a positive spread, all right, rather than a negative spread. All right. So that makes sense. I mean, if that makes sense, hope everybody's clear. All right. Hope everybody is clear. Okay, good, perfect. All right. So for the last couple of minutes, all right, we're gonna talk some entries here real quick. All right. Don't have that much time, but I think I actually posted the sessions from last week. We went through order blocks and imbalance. All right. I hope guys that that would have helped you significantly last week as it relates to your entries and so on in the market. All right. And again, like I said, like just put everything together, life gonna change. All right. So if you actually go to I have those two sessions on my YouTube. All right. If you go to my YouTube, you see it here. So this was the live session. It was the trading session that we had. All right. And we had this was the session from last week, part one. I got to upload part two. All right. So order block and the imbalance. All right. Part one, we went through those things. You could plug in, go over that information here as well. All right. So let's talk entries. Let's talk, like how you could avoid some entries as well, especially because we went through we went through order blocks and imbalance and so forth last week. All right. So classic example, right? When we pay attention here, guys, you see this trade right here, euro to the Australian dollar. This was a great order block. Imbalance, everything that we would have spoken about on the previous session, right? We got that order block, we got that imbalance, right? So the expectation was, when price gets back here, we would buy, right? Anybody had that thought? Don't lie to me. Anybody would have that thought? All right? Don't lie to me. Don't lie to me. All right? Let me know in the chat, right? Talk to me. Yeah, yeah, you will have that thought, right? But here's how, and always remember what I say, that everything works together. Or the blocks imbalance, the fair value gaps, liquidity, everything works with market structure. All right. So, right, how it works with supply and demand. I think we went through that in one of our earlier sessions as well. We'll go through that again. All right. But here's what basically would have occurred here. And this is why, you got to look at what's going on in the market. Right. Now, remember, we had targets up here, right? We had targets for price to come up here and look at where the market actually came. All right, we saw price traded into the area that we were looking to sell from. All right, so look, bigger time frame perspective, price tapped into the area that we were looking to sell from. So what does that mean? Right? What does that mean? When price come back to this area, it is highly unlikely that we are going to buy. It's highly unlikely that price is going to hold. Why? Because price traded into a supply zone, right? What happens in supply zones, guys? What's happening in what do we call it? A supply zone. What's happening up here? Remember, I always say let trading make sense, right? What's happening up here? Talk to me. Sellers in control, sir, right? The sellers in control. So this is where the sellers are at. The selling pressure is here. The likelihood of this demand holding is very unlikely. So here's what we do. Because I said it's very unlikely, this is impossible. All right. So here's what you do. All right. Here's what you do in scenarios like that. When price comes down into these areas, what you want to do is wait for that lower time frame break of structure. What does that mean, Kai? All right. What does that mean? You're waiting for price on a 1 minute, 3 minute, 5 minute, all right, to give you a break of structure. So again, what does that mean? That means that price came down, traded into your zone. So let's just say, for argument's sake, this is your zone. You're looking for price here, right? You're looking for price in here. Perfect. You got price traded into that area. Okay. So you want to see, right? What you want to see price, boom, give you a break like this. All right. So take out this previous high. Okay. You want to see price trade up like this. Then pull back. Right. So this is your lower time frame breaking structure. Right. So it breaks above the lower high, pull back into this area where you have the same thing that you were looking for here. You're looking for that imbalance. You're looking for that order block. Look for the same thing in here. And then that is where you take your trade setup from, right? And like, so if it does not give you a lower time frame breakout structure, why are you in that trade? All right, watch what happened here. So we on a 15-minute time frame, we see price, boom, drop right through. All right, you're not trying to trade that. All right, price came into the area, boom, drop right through. 5 minute, right? Drop right through the area. We on a 3-minute time frame. Let's see what happened. Boom, market drop right through. You had no opportunity to be buying. All right, there's no opportunity here for you to buy at this point. Market drops straight through the area, right? And this is why sometimes, especially in areas like this, and this is how you could kind of stop yourself as well. When you got price already top in, or what we would call mitigate, right? I'm gonna use some terms for you guys, right? We will call when price has already mitigate a particular area, right? Like you don't want to go at it with an aggressive entry. All right, and aggressive entries are that first entry where you just put like a buy limit in or sell limits in and so forth. You want to make sure you go about it, safe. All right. You want to make sure you go about it in a safe manner, right? In a manner that makes sense. Okay. So, right, let me know if that makes sense, right? Because again, I'm showing you guys how to look at the market, how to enter the market, and so forth. But at the same time, you want to know, all right, when do I not enter the market, right? How do I avoid taking unnecessary trades, right? How do I avoid taking unnecessary trades, right? So I'm gonna show you once again in terms of like where you want to take trades and so forth, all right? Where you want to take trades. So remember always, right? Remember always, you want so I want you guys to pay attention to what's going on. Yeah. So if this is where we are at, okay? This is where we are at. You come and you see this, all right? This is what's happening right now in the market. Few things you want to make sure you take a look at because remember, we are looking for entries, all right? What makes up your entry? I sent this to someone today, all right? Few things you want to look at. You want to look at the structure of the market, okay? You want to look at the structure of the market first and foremost, okay? Secondly, identify the areas of supply and demand, right? Guys, like I said, this ain't no strategy, it's just what you should do, right? This is what you really should do when you anytime you're trading. Okay. So one, you look at the structure in the market. Two, you pick up, where is the supply and demand? All right. So when it's a structure in the market, you want to know, okay, the price break in the structure, right? Where are we actually at? Are we in an uptrend, downtrend? Where are we at? All right. Secondly, identify the areas of supply and demand, right? Because you want to know, do I have space to buy? Do I have space to sell? Am I looking to buy in an area, right? Or whereas the market already mitigated the supply zone, right? Where price is strong on the sellers, right? Am I trying to buy in an area where price already tapped? Like those are questions you want to ask, right? So that's what you want to identify. Where are you at? That's you identifying the supply and demand zone. Hope you guys taking notes, all right? Then you want to be able to see, okay, where could price actually pull back to? Right. So let me identify the imbalance or what we know as the fair value gap. Where could price actually pull back to? Right. Where's the area that I'm actually looking to buy or sell from, right? Where could the market come to? Once I got that, right, then obviously based on the setup, right, or based on the type of pullback, was there a liquidity grab, right? Was there a liquidity grab, right? The price, set up and create, that area of liquidity, again, based on the type of pullback that's happening, the area that we're looking at, is the area that we are looking at, did we have a liquidity grab? Was there a liquidity sweep, etc.? Like we want to ask ourselves those questions. Why? Because those strengthen the area that we are actually looking to enter from, right? So it's like here, structure, you're getting the bias in. Am I buying or selling? The supply and demand, you're getting that bias in. Am I buying or selling? Okay, no, you're asking yourself here, where am I buying or selling from? Right? Where am I buying and selling from? And here now we're looking at the strength of the area. So, okay, cool. Liquidity, do we have all those confirmations that we basically want to have in the market? How strong is the area, right? Then we look for the order block. All right, we look for that order block, right? Because the order block is very rarely setting up our entry. Yeah, the order block is where we're really setting up our entry, right? That's the ideal area that we are looking at. Okay, that's the ideal area that we are looking at. Then we have then of course we start to pick up our entries. All right, we start to pick up our entries. Yeah, so this is the area we mark our entries, etc. And then in based on the scenario, all right, which is usually the safer entry anyway, we want a lower time frame break of structure, right? So lower time frame break of structure, we get that, guys. Run the entry. Right? Run the entry. You got everything that you need at this point. Run it. Don't second guess it. Run it. All right? You're gonna hear me in your money like, bruh, you tick, 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 run it. All right? Behind the people trade. It's either you're gonna win or lose at this point. Right? Give me one sec, guys. I got another call. Right? So that's literally what you're looking for, right? So for example, in this scenario, same thing here. Based on where we are at in the market structure, are we on the 50-minute time frame? This was our last lower height, right? We get price come down, boom, market broke that. We got a lower time, we got a break of structure at this point. Phenomenal, right? So first thing. Secondly, right, we identifying that this was an area of supply. All right, we could see that we don't gonna guess it, right? We can see this is an area of supply, right? We will go through that on another session, like identifying supply and demand areas, right? If we look at demand, we can see here this was a demand zone. So, all right, cool, right? So, with that in mind, do we have space to sell? I'm talking to you guys. Do we have space to sell? Right? If this is our demand zone, do we have space to sell? I'm gonna answer it for you. Right? Yes. Okay. You got space to sell. This is where you sell from. Okay. Sell from supply to demand. Right? I mean, it only makes sense. Right? So do we have space to sell? Absolutely, we do. Next thing, where's the imbalance? Do we even have imbalance in the market? Because again, that's what is going to strengthen the area. Right? So we got imbalance. We can see the imbalance is clear as day right now, right? From here to here, bam. We got an area of imbalance right here, right? Area of imbalance. Phenomenal, right? Did we have that liquidity grab prior? Yes, we did. Price traded above that particular area, slightly above that area. Let's see, smaller time frame, not really, but yeah, smaller time frame for sure. Right. So we got liquidity grab for sure, right? So great, phenomenal, right? So we in that area, we are seeing what it is that we want, right? Phenomenal. So order block, we started to set up our order block, right? We started to set up the order block because now based on this, we can set this up from a 50-minute perspective, right? So we can say this right here, right? I'm gonna just move this as it is right now. This could be our order block here. Boom, right? But we know where the imbalance is as well. And as we know, price could trade off your imbalance, or it could trade off your order block, all right? Ideally, we want it from the order block, right? Now, on a 5-minute time frame, and this is where you just gotta pay attention to everything, all right? Share with you how my money works. On a 5-minute time frame, what you can see here as well is an engulfing candle. So for me, the possibility of price selling, from in this area as well is definitely there because on a 5-minute perspective, I don't necessarily have that imbalance in this area, right? I don't really have that imbalance here. The price traded balance. We got this wick, market pushed down, pull back up here, then we dropped again, and we created imbalance back in these areas here, right? So the perspective of it could, come back up into that area, definitely I'm open to, right? But I'm definitely be open to this as well. All right, cool. So we got everything at this point. You already blocked the entries, right? We got the entry set up now, and we set up, where is that we could potentially buy or sell from, right? We could sell from this area here, right? or we could sell from higher. Ultimately, I put my stop loss above. Why? Because I understand that I could sell from higher. Okay, I don't want to get knocked out unnecessarily. All right, I know that I could sell from higher, or we could sell from here. Right, so I'd rather get any trade with a low 50 pip stop at max. That's the most I'm gonna put on gold. Right, 50 pips. Anything above 50 pips, absolutely not. All right, but 50 pips, that's what I'll do. When price gets in the area, no, we either grabbing the entry on the first entry, or we're gonna wait for a lower time frame entry, right? So in this scenario, I ran it based on a first entry, right? Um, but this, so we see here, right? Whole price just top the area. Just zoom in, all right? Price literally just top that area. On a lower time frame, did we have anything? Oof, not necessarily. All right, so that was one of those hit and run type of situation, right? Where price just boom, top it, and then we started to drop. Okay. Now, if you miss a trade like that, where price top the area and move, then you just set up for the next entry, right? The next potential entry. Doing what? The same thing, right? Do the same thing. One, look for the imbalance. Identify the order block, right? Like do the exact same thing that you would have done here for this area as well. That's what I would do, right? So I would set up accordingly, whereas if I could get an entry back at this point, great, right? We will see, based on this is a 15-minute candle, 15-minute engulfing, probably may not get all the way back up there, right? Especially if price closes like that, so then you'll be looking at like this candle here that got engulfed, that's how you will start to break it down, okay? So you just take everything into consideration, to be honest, guys, right? And then you see how price starts to trade. Boom. So you pull back up, right? Look here. All right. Look here. So you actually would have got another opportunity in this imbalance. Okay. So we see how price boom moved off. On the 15-minute, it would have been just back into the this candle here, this order block. All right. So this entire candle on a 15-minute time frame is what you will be looking at. Okay. See how price push down, boom, traded back into it. You got another potential entry, and then bam, price drop. All right, and price drop. All right. So you guys see what I'm saying here? All right. Pretty simple stuff. Right. And then you do the same thing again. You're looking at this point. Where's the order block? Was there a liquidity grab? Absolutely. Bam. All right. Market push down, left imbalance. Absolutely phenomenal. We see all that. All right. Everything is clear. We're looking at the imbalance. We're looking at the order block. Everything is here presenting itself for you. So what we're doing is waiting for price. Once again, trade back into this area and then we run it. All right. We got these seeing confirmations. One, we got price break structure, right? We got the imbalance being created. Yeah. We got the order block. We got liquidity grab happening here. Boom. We got the order block created and so forth for us. Phenomenal. When price gets back, we are going to run it. Boom. Market in. Take the trade. Don't stick up. All right. Boom. You enter that trade. You do if you want to do the same thing from get some lower time frame breaks, all right? You can do that. You got the price wick, it push down here, pull back up into this order block right here on a 3-minute time frame. Boom, market dropped again. All right, and that's all you need. You do the same thing over and over and over again, right? Until okay, until what, guys? Until until it don't work, right? Just know that nothing is 100%, right? But just know that you are looking for your same setup every time. You're looking for the same things every single time, right? And you just run it, right? You just run it, all right? So I hope that was of value to you guys, all right? I have another session. No, all right? I hope this was of value, man. I hope you guys really took what I said and like you could see the simplicity in it, right? Literally this market structure, supply and demand, imbalance or fair value gap, liquidity, order block entries, lower time frame, market structure, and you gone clear. All right. If this made sense, so you're all clear for the AC in the chat. I know you guys are gonna want to go over this information. That's absolutely fine. I'm gonna make it available, right? But I definitely need you guys, man, to see like, yo, this thing could be simple, right? So this is one type of entry. The next type of entry would be like the entry that like Romario would have sent today, right? That's another entry model, right? That I would have adopted, right? Stole it from Mario and made it my own. Stole it from Mario's on the go. I stole it from Mario and made it better.
Hey, yeah, fam. Don't worry, man. It's all good. It's all good.
I stole it from Mario and made it better. But yeah, man. So, that's what you gotta have, people that you run with, right? Because for the life of me, for like the last maybe as long as I've known Mario, I was like, bro, I do not know how you just enter the market like that. All right. I cannot see myself entering the market at these low points. It's either high or it's low. I can't see like me buying in the middle. I'd be like, sorry, me selling in the middle. I'd be like, why would I sell down here? Like that don't make no sense at all until they found a entry model that made sense. All right. So I was like, okay, I see what you be doing, but it got make some more sense to me. So we're gonna get to that as another entry style as well. All right. This actually missed an entry that I had. I took Mario's entry though, don't worry. All right, this missed the entry that I had. I had it set up a long like back when price dropped here, I had that entry set up at that point. But again, I mean, it was like based on the same thing. You know what I mean? Imbalance, the order block. Yeah, don't worry, we're gonna get there, man. We're gonna talk about that. But guys, I hope this session made sense. Like I said, go ahead, do your homework, study, man. Do this thing, practice, 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 and look out for a call from Mario. I think you're doing that call tomorrow night, bro.
Yes, sir. So the agent session, what we plan to do is well, actually just tomorrow, right? We're going to be doing it from 10 p.m. AST. We're going to be doing live trading only. Live trading only. So if you guys are available, you want to come in and trade with the rest of the team, plug in at 10 p.m. Right? But we're going to organize everything and send it in the chat so that everybody knows what's going on.
Let's go. We got some people, man, that would love that because they'll be like morning time, they at work. So 10 p.m. nighttime, they're gonna we're gonna have that session for you guys. All right. So with that being said, guys, do have a good one. All right. I'm gonna see you guys on the session tomorrow morning with Neymar. All right. And then tomorrow night with Romario. Be blessed. Have a good one.